So without further ado, I'll introduce the first panel here today. It's the role of market psychology in influencing market trends and how to make informed decisions in a volatile market. And so to lead this panel, I think we've got the perfect candidate to lead this panel, and Mr. Wong Kon Hao. Mr. Wong, firstly, welcome to Jakarta. Thanks for coming down. Mr. Wong has started a company called Wepedia, which actually trains people in pretty much this exact topic in terms of making informed decisions in volatile markets. After all, if a market's not really volatile, there's maybe not so much opportunity as well. Mr. Wong's also, he's a private investor. He manages his own private capital. He's here today representing CME Group, and he's had over 20 years in the markets as well. And so without further ado, I'd like to invite Mr. Wong to the stage to take this panel.
Thank you, Mark. And also want to thank you, Melissa, for the opening speech. And I just want to affirm your vision for Indonesia, that I was walking down the street at the Chillax last night. It's definite I could see that there's a long runway. Among the Asia country, there's a long runway for Indonesia development. Now, why I say so? Because back home, our minister has spoke very well about Jakarta, Indonesia. Now, he said, and most of them say that there's a lot of young professionals, many young professionals in Jakarta, in Indonesia. That makes a difference in Indonesia compared to the rest of the Asia country. Why young profession is important, not just IT, but young profession is important because I was young 30 years ago. So it means that you have a large population of young talent. It also means that Indonesia and especially Jakarta have a long runway. Just want to second your vision about Jakarta. And also talk about risk today. I'm going to share with you a lot of data point about risk, but I think for this season, the theme that I use is this. Yes, I'm going to share a lot about risk, but among the participants is this. If we know what is the risk that's lying ahead of us, we discuss about it, we acknowledge that, and we know what's the risk lying ahead of us. Are you still seeing risk ahead of us? Or are you seeing opportunity that's lying ahead of us? We're going to talk about risk, but risk management. Then where can we transform this risk to an opportunity? Now, let me just start this, my presentation formal. And first of all, I want to thank you, CFA Society Indonesia, the board member, Ms. Melissa Hedrawati, thank you, and board member, Mr. Mark Burney, and also the executive director, Mr. Rahmat Halim. Thank you for having myself and my partner, who is a CME Group, Mr. Harry Yo, that is here today. And definitely it's my honor to speak alongside with Mr. Tommy Chu and the rest of the panelists. And definitely a great pleasure to meet up with many of the distinguished guests this afternoon. Now, today we're going to talk about how to navigate through worldwide volatility. Now, many of my friends ask me about, Connor, how do you know that the risk is coming? How do you know that this opportunity is coming? Of course, when I say how do I know, I do not mean that I'm always absolute. We can never be absolute in what we're seeing. But relatively, I think we can score maybe 70% right most of the time. I think that's pretty impressive. The 30% when we're wrong, we just have to risk manage it well. Now let's go to the next slide. Yeah, so today, a lot of my friends ask me, how do I know that the risk is coming or the opportunity is coming is this. I think I got to credit my earlier days about coming to 30 years ago, that my first career I started on the trading floor itself. Now, I was a floor trader. That's how I got started as an apprentice. And I dragged myself functioning as a floor trader on the trading floor because my personality do not fit into the environment. I'm an introvert, and the environment is loud. The traders are loud. They are gung-ho. They fight to get a trade. They fight to get their trade. And 3 years, I thought I learned nothing on the trading floor. So I asked to be transferred to be as a dealer in the office. But when I was at the dealer, when I look at the prices, the buy, sell, it flashes the last done and the charts, and I have a wake-up call. So what I spent, I thought I wasted my time for 3 years on the trading floor. Everything, when I was on the screen, makes sense what had happened on the trading floor 3 years, where I dragged that journey. Now, when I look at the chart, when I look at the screen, the flashes, the buy, sell, the last done, the volume, suddenly a wake-up call that over the last 3 years on the trading floor, I've not wasted my time. I begin to understand that I could see that there's a lot of fear within the transaction, a lot of greed, a lot of confidence. When I say confidence, it could also mean insiders trading as well. Now, let me just explain how the floor trading works here. Today, when we trade the market, invest in the market is through electronic, where Joseph is very familiar with. Now, it's all digitally transacted, matched. But in the past, it was floor traders. So as a human, we match trade. 1,000, at 10,000, we match trade. So within this chaos, the matching of trades, in fact, there's a lot of emotion that's go beyond within this transaction. Again, it's fear, greed, and confidence that I'm going to describe that tonight. Within all this transaction, that encompass macro development as well. So we're going to study deep about how to recognize all these. So today, as I look at the digital transaction on the screen, as I look at the chart, so my mission, or I try to read into the market, is that can I sense the greed? Why is there a need to sense the greed? Because when there's a greed in the market, it also means that this price may be overvalued. But whenever there's fear in the market, which may not be bad if you're not in the position, it also means that there's an undervalued situation. Everyone is selling. Whenever there's confidence, maybe it is time for us to take a second look to restudy about the whole situation. Could it be time to get into the market? So we're going to study into the market psychology today. So it's always an honor and pleasure to be here. And I have a mission statement to be on the platform. And I hope that what I shared were able to create a lateral thinking skill for every investor traders, including the institutional investor as well. Knowing when to take a calculated risk like today, and definitely a bolder risk when there is an opportunity. So yes, I'm going to talk about risk that lies ahead. But again, when we know what's the risk that's lying ahead, I'm not seeing risk anymore. I'm seeing opportunity. Now, so this is what we are going to go through, which is I'm going to first cover about what I know about market psychology and trading. Then after that, I'm going to move on to study the mass market behavior, where I believe that most of us will have went through that before as a retail investor, but it's good to understand and study about them because it represents the mass market. Through this example, I'm going to study and dissect into the greed, fear, and the confidence. Then after that, I'm going to give you some example on the crude oil and also an example how to apply that in inflation, of course, followed by Q&A. Now, how do I define the market psychology is this? Now, behavior price movement refers to the fluctuation in price of a financial assets that are caused by a collective behavior of investors, traders, events. And I noticed that all these behavior patterns, it tends to repeat itself again and again. Now, again, it is not absolute, it is relative. So if we think that is absolute, then we're going to fall into the trap because there's always a 30% risk. Then we have to, if we are wrong, we just have to manage that risk effectively. Now, let me just impress you a little bit, but I think beyond impress, what I'm trying to share with you here is that with this 1 hour sharing, I hope that later on, as you go back to your office, at home, when you analyze the market, this skill can be transferred to you as well, that you can seize the risk and the opportunity as well in your office, in your desk, and at home. Now, so on the 21st of July 2021, I have this sharing. Now, I want to bring you back to 2020-21. How was the market like back then? Was there inflation? Was there a higher interest rate in 2020-21? I think most of us have forgotten in 2020-21, there's no such talk about that inflation is here and there's higher interest rate. Yeah, there's no such talk about. But yet, in our sharing in platform like this, we identified that during that period, 2020-21, inflation is on the rise, and perhaps for that reason, higher interest rate will to come. Now, so this is what we shared. Now, it may be technical. I think most of us understand about what is a hammer, just by studying into price behavior. When we look at a chart, what are we studying into? Now, if I'm going to reconvert this chart to data, so the data scientists will be very interested here today. Honestly, we're doing data analytics, but data analytics will be very tough for most of us to understand. But if I'm going to convert this data to a chart, it forms patterns and pictures. So what we studied was the 5 years interest rate and the 10 years interest rate. And that was 2020-21 in July. And I've recognized that then the interest rate for the 5 years was at 0.7%, and the 10 years was at 1.2%. Now, by recognizing these patterns, I assume the studies is that perhaps interest rate is on the rise. So personally, for my investment, whatever is on loan, on leverage, I try to deleverage, because it's not wise when interest rates on the rise, you're heavy into borrowings. I'm referring to my own property investment. It's time to deleverage. So of course, I also share this message to my friends and those who are willing to listen. Next slide. So what happened where I prepare all these on Monday? So this was what we saw on the 5 years interest rate, where it became so micro at a point in time, this little hammer. And today we're at 4 I can't see, so small. So that's what happened when you're 51 years old, you can't really see well. But I'm glad that wisdom grew along the way. So can't see well is all right. We use more of our brain. So today the interest rate was at 4.7. Yeah. But the float rate is 5%. The Fed fund rate is 5%. And there's an inversion right now. And let's go to the 10 years interest rate right now. Maybe just shrink a little bit. So what we discussed that in July 2021, it was this little hammer here. It seems so insignificant then, but today is at 4.1%. Next slide. So again, it's not to impress you what I can do, but more than what you can do at home. We can recognize pattern, and when we understand the pattern, we try to take it a little bit more seriously, study the macro development, the micro development as well. Does it match to what we are seeing here in the technical or data analysis? Now, so what do you think about this 40 years interest rate? I'm not talking about the interest rate. And do you think that interest rate is on the rise? Now, next slide. Now, if I'm going to draw a very simple trend line like this, and I believe that this is from 1970s to today, and what we're seeing here, the post-COVID interest rate, it seems to me that you have just broke this major downtrend line. And I think it is interesting, like what Melissa said earlier, it is time to look at the macro development, the geopolitical risk, what will cause commodity to rise, and will there be a risk that inflation is going to continue to rise, so that the Fed will also consider to maintain or hike the interest rate in the near and far future. And I believe that there's some risk moving forward. So again, we're not going to talk too much about risk, but rather how can it make use of this risk that we know ahead, turn that into opportunity. Next slide. Now I'm going to talk about this is going to be a little bit fun now, some animation. And we're going to study into the mass market psychology. I think many of us, before we became an institutional investor like yourself with your company, we were once an individual investors. Now, I'm not here to shame the individual investor, but rather as I shared this, I hope that the individual investor will also be blessed. Because if we are into folly, but yet we're able to learn what we have done, the mistake we've done in the past, we develop an interest, we develop a skill, we can all become better. Now let's study about the characteristic of a mass market psychology. And I'm going to discover about this characteristic, this investor, her name is Catherine. And now if you come across any individual that always like to say this word, and as investors and traders, we try to minus off, cancel off this vocabulary in us. Now, it may happen to you. For example, you have taken profit and the market run up even more. That you may say that I should not have taken profit. Try to minus up that off because you are blaming yourself, which is harmful because over time you will create a lot of emotional baggages. Or if you have cut losses, then market rebounded. Then you ask yourself, you blame yourself, I should not have cut losses. So this is harmful over the long term. Now, so how do I recognize the mass market? Because there's a common vocabulary that they use. They like to say, I should not have. I should have. Now, next one. Now, this one, you need to go a little bit faster with me because this is an animation here. So we're going to study into the mass market behavior. Now, let's move on. Next one. Now, usually the mass market, I'm talking about the retail investor. So as an institution, it's good to understand what the mass market thinks and behave. But again, of course, we're trying to help them not to corner them. That's not the whole idea. Now, usually the retail investor, or the mass market, they are ignorance. We have to recognize that. When the price dropped a lot already, my friends say that it is a good time to buy. I will buy now. They invest and trade out of ignorance. So as the price dropped even more, next slide. Next slide. Yeah. They say, oops, it is okay, or I buy some of the average rate, and they average on their losses. So we don't do that. Move on. Next one. See, I'm right. Next one. Stress. Next one. So then the first mistake they made is that they average on their losses. When it broke the low, they are so stressed out and they cut loss. Now, the emotion is this. We try to read into the market development. We try to read into the mass market emotion. When they over-leverage, overstick what they have, likely it will cause them to cut loss. When they cut loss, it also means that market is undervalued. Could there be a proposition on buying opportunity? We're going to discuss that shortly. Now, let's move on to the next slide. Sign, please don't tell me I cut at the low again. Move on. See, I told you market is coming down. Next slide. I don't believe this. Never mind, I'll wait for it to come down or buy again. So he is getting a bit angry right now, or she, because I'm referring to Catherine. Next slide. But market do not wait for her. And this is the time that we have to recognize if the market on FOMO mode. FOMO means fear on missing out. Now, because it's so high, for example, where is the FOMO today in the stock market? In the AI chase, in the AI euphoria that we're seeing. There's a lot of FOMO. And a lot of us are thinking, I should buy now if I'm not going to miss it. Why I say so? Because I literally every place I go to, people always ask me, which AI stock should I buy now? It's so high. So there's this euphoria that's going on FOMO. So we have to recognize is that stage of whatever product that you're investing and trading in right now is in a FOMO mode. That means that the price at this point is overvalued. Move on. So after she has invested, market dip. Next one. It is a good stock. I am a value investor. Now notice that Catherine started as a trader. But when she lost money, she got a bad experience here. She said trading don't work. Then after that, she became a long-term investor. So we can recognize the patterns of the mass market behavior. Next one. And I cannot believe this. Okay, let's move on. Now, so we're going to recognize when we look at any market, so this is just one example. So what market was that? I believe that there was a gold market, but it applies to almost every market. So that when we look at, it could be crude oil, it could be gold, it could be the yield, it has all this very similar behavior. But more than that, I want to recognize the emotion behind all this mass market. What is it all about? And how to recognize the market, whether there's an element of greed. Let's move on to the next slide. Now, based on this story that I just told you, a case study for you. Yeah, I think it's always good that we have some practical experience. At any particular point, where do you find that the greed is in play? Which point? I'm not going to ask you to stand up to answer me. It's okay. But just take a moment to identify this progression. Where is the point of greed of the mass market? Okay, next slide. So I think most of you are right. So we have to recognize where is the FOMO, fear of missing out, and they're buying huge. Yeah, and it create an overvalued situation, and that may be a situation that you can consider you should lighten up and to take partial profit. Next one. Now, so it's very different from this stage because again, at that point when Catherine bought or invested mass market, they bought out of ignorance. Remember that as the price dropped, she continued to average in. Yeah, it's out of ignorance. So there's a difference between out of ignorance and FOMO. So FOMO is usually something that I'll look out for in any markets. Let's move on. How about, can we recognize where is the fear? So we have just identified how to recognize the greed, but how can you recognize the fear in any market based on the demonstration? Next slide. You're just going to take a few seconds to analyze where is the fear. I can tell that this practical exercise is good because I suspect that after this session, I'm not too sure if you're going back to the office. Some of you gentlemen over there, you may want to look at the market that you're trading in or investing in right now to identify where's the fear and where's the greed. So where is the fear? So I think this is quite easy compared to the greed, right? Let's move on. So the fear is this, out of ignorance. They keep on buying, averaging. They commit their mistake again and again until the market falls so deep that it hurts their emotion, it hurts their pockets, and out of that emotion, they just throw the market. And it created an undervalued situation. And that could be a situation that we should take a closer look at any market. Now, let's move on. Let's move on. So like what I say, out of ignorance, it may create fear. Out of FOMO, it may create greed. And then how to identify the confidence of the market? Let's move on. And I hope that this data point are useful for the data scientists. I'm not too sure how it works, but I hope you'll speak to all the data scientists, then things will get into more productive into your system. Now let's move on. Now, how to identify the confidence? Now, this is something interesting that I want you to take note of. So we identified what's the fear. We have identified what's the greed. Let's move on to the next one. Now, let's move on. Next slide. Now, could you see that we have discussed about the fear and followed by the confidence? Now, what we have to understand here is that maybe we move on to the next slide here and next one. Now, could you see that with Catherine, the mass market created a fear, but suddenly the market also moved up. And I'm particularly interested in any asset class or any instrument when this thing appears. Despite of all the negative news that created so much fear by Catherine, despite of the negative news still intact, I don't see any positive news around. And suddenly I could see that the price behavior started to edge up with huge transaction volume without the absence or with the absence of good news, then I'm a little bit suspicious that could it be an insider's trading that's coming up, or could it be someone, it could be a fund or many individuals know something that is not available in the market. So that's what I work in the arbitration or to help the attorney or the lawyer solve some trading dispute using this. So to summarize is that how to identify confidence is despite all the bad news that created Catherine to sell off, what is causing the market to move up with the absence of good news? Now let's move on. So that created this, what we call the bullish engulfing body. And if you combine these two together, you are able to see this price behavior where we commonly know as hammer. Do you know that when you combine these two together, you will get a hammer? And remember just now we saw that 2 years and 5 years, or is it 5 or 10 years yield? We saw a very classic hammer. But if you're going to combine these two together, that we saw a hammer. So for the yield, I've been waiting for some years for that to happen in July 2021. I need to see that price behavior that's speaking to me. But before that, I know that the macro development are building up for a higher interest rate that we're in today. Now let's move on to the next one. Now, how about this one? With the greed, with so much good news like today, the AI hype, for example. But what I'm looking out is that despite with all these good news, there's no bad news. Suddenly, this thing appeared. Next one. Next one. Now, with so much good news around the AI, it seems to me that today, a lot of investors have forgotten about the risk of inflation. Many of us, I'm talking about the mass market, have forgotten about there is still a risk of inflation because it's overshadowed by the AI hype. Now, with so much good news, and suddenly if the market turn, we'll be quite concerned. I'll be looking out, I will start to analyze what actually happened. And this is what we commonly know as the bearish engulfing body. So when we look at all these patterns, it's not just patterns by name, but we have to understand what is the psychology behind these patterns. That's just how I use to identify all these turning point, the macro trend. Now, next one. Now let's apply. So I just share with you some fundamentals about how to identify the turning point. Let's look at the application right now. Now let's move on to the crude oil. Now, this was prepared on 17 August 2021 at a point in time. My expectation that crude oil will edge up to today nearing about 90. And I suspect that in the near and not too far future, we're expecting crude oil to go above $100 and more. Why? Now, let's base on what we've discussed earlier on this crude oil over the last 20 years. Next one. Now, first of all, we have to understand that some macro development back then in the before the 08 crisis, the main supply for crude oil was mainly OPEC, and there's a new demand by China. So we could see that the market have overdrive, and it formed that there's this euphoria in the crude oil. Now we could see that there was an inverted V. So earlier what we studied is all the inverted V shape and also the V shape, a sharp V shape that forms bearish engulfing body or bullish engulfing body. It also forms hammer and inverted hammer. Yeah, so do not just understand it by name, but try to understand the psychology behind the development. That's more important. Now, next one. Now, if we could see that this inverted V is also a bearish engulfing body, and we could see how the market have turned. Now, next one. In 2008, of course, we knew that there was 08 crisis because of the subprime. Let's move on to the next one. 08 crisis, next. And we saw that there was a V shape, a very sharp V, which is also the bullish engulfing body. Next one. And because of the OPEC and US shale standoff, the market have dipped, and we saw a V shape, which is also next one, which is the bullish engulfing body. Next slide, please. And this will be very familiar to all of us, which is just happened about 3 years ago because of the supply chain block. And it requires the producer to spend more on the storage of oil and the cost of oil price to dip below par. But I want to take notice that this is a very sharp V. When sharp V happens, it also means that the potential upside is very strong as well, technically. Let's move to the next slide. Next slide. Can you see that there's a potential sharp V? When you combine these two together, you'll form this hammer as well. Now let's go and study a little bit more intimately on some fundamental about the crude oil and the rest of the commodities. And then we're going to narrow down to the CPI, and we're going to narrow down to the interest rate. Volatility will come, but I will embrace it as an investor and traders as well. To me, it's all good news because with volatility, there's definitely so much more trading opportunity that's around. Move on. Now let's apply inflation. Let me just give you some progression, what's happening to the market. Move on. Now, US bank run, it was March this year. The bank run was caused by high inflation. But today, I think many of us have forgotten that there's a bank run ever exists. But I can tell you that the bank run crisis is still there because if you're going to study into the 4,000 stocks, banking stock in the United States, it seems to me that only JP Morgan is above the March prices high, and the rest of 4,000 banks is still below or around the March crisis prices. So the price behavior speaks to me that the bank run crisis is far from over. So we still have to look at the banking stocks very carefully. Now, but I would say that the market at the moment is giving us a lot of hints why it's coming right up. Now, I got this formula. If you ask me that whether inflation is on the rise, I will look back at commodity prices. Or if you ask me whether interest rate is still on the rise, I will look back at inflation and I'll look back at commodity. So therefore, we have to study about the raw data or the raw prices of whatever we need and we use daily, which is commodities. Next slide. Now, this one may appear a bit complicated, but it's easy to understand. The yellow lines represents the commodity prices, which is crude oil. This is crude oil. And the yellow is the deep orange is CPI and followed by interest rate. Now, let's look at what happened to the COVID-19 where the crude oil went below par and it rebounded to this exceeding 100, which is not that long ago. But you'll notice that when the Fed decided to hike interest rate despite of a rise in commodity prices, using crude oil as an example, it took them, next slide. As oil price and rest of the commodity rise, it took the Fed, next slide, 23 months later to decide to hike from 0.25 to 0.5%. So what I'm trying to suggest here is that the formula to understand inflation and interest rate is first we look at commodity prices because that is the real data. Where is the commodities today? Is it higher than before? Then we will know that what is the CPI, whether it's a core or CPI is going to do, because all this data, the agency need all this data to feed them. It could be a few weeks to a few months later. And the central bank will take much longer period to identify whether are we still in inflation or not, to hike, pause, or to ease the interest rate. And we could see that as oil price rise, it comes to a point that CPI, there's an exponential effect. Now, another example about the lagging effect between these three components, which is commodities, inflation numbers, and interest rate. Next slide. Well, the oil price reached a high and it's to move down over the last whole year. In 2022, the oil price dipped. But it took the CPI, next slide, 3 months later to register the peak. Then it started to come down. While the interest rate is still maintained at a high because I believe that the Fed understood that all these data points are still elevated. When I say all these data points, I'm referring to all these commodity prices are still elevated. And Jerome Powell did say that we studied into my predecessor in the 70s and 80s. We do not want to cut the interest rate that soon because what happened back then in the 70s and 80s was his predecessor cut rate too soon. And then we all know the story that the CPI started to reverse up very strongly. He do not want to commit that mistake as of yet. But yet, during each FOMC conference, I could see that the gullible reporter asked him, are we going to cut the interest rate? They're very gullible. Why I say so? Because this reporter are basing on a CPI of last year, June at 9.1 to about 3%. They say that the inflation have come down so strongly. It's time to cut the interest rate. But what Jerome Powell and his team are looking beyond the last 1 year CPI. He's looking the last 40 years. And he knows what's on the table. And he's very consistent with his statement over the past FOMC meeting. He said this, we're going to study into the data point, month to month, data to data, the totality of the data before we decide what we're going to do next. So basically, in short, he's asking the reporter, please do not put words into my mouth. We do not know, but the data will present us to the fact for us to make that decision. So what do you think? Moving forward as the crude oil from about this low, I believe about 40, and today is nearing about 90 US dollars. The crude oil is on the rise. So what do you think about the CPI will do? From 3%, the latest reading was at 3.2. And now we could recognize why the Fed want to maintain the interest rate at this high point, either to pause or to hike, which I believe that in 2024, my personal conviction here, based on my reading, is that unlikely it will cut an interest rate in 2024. And I hope that that will bless you because, again, I say that if we know what's the risk that is ahead of us, I'm not seeing risk, but I'm seeing opportunity. Now, let's move on to the next slide. We have just discovered about crude oil. How about the rest of the commodity prices? Now, this was a COVID low, and this was a crude oil that we studied. But among all the commodity prices, now, how I measure inflation and interest rate is that I like to look at this group of CME commodity prices. I listed all of them, the top 16 of them. So we are seeing my first page here. But what we could see here since COVID low, the gold is still around 2000. Oil, where we just studied. And I believe that oil is in a bull trend. And the last year dip was a retracement dip for bull to come. It's not a turnaround based on the geopolitical tension that we're seeing, based on the, could be the dollar that I'm seeing here. Over the last 1 year, since September last year, the dollar has been decreasing based on the dollar index study that I did. But look across all the commodity based on the COVID-19 low, most of the commodity prices are still elevated. And the meat price, the cattle, the live cattle have broke its all-time historical high. So what is my reading here on the commodity prices? It's still elevated. Next slide. And so what's your reading? Next slide. So let's do a case study on the long term. And now I'm going to pass the table to you to analyze, where I have not discussed about this topic. Earlier, I shared about hammer, inverted hammer, to understand the psychology behind the hammer, inverted hammer. Now let's look at this case study on the crude oil prices based on the price behavior study. Next one. Now my question to you is that this is a yearly chart of oil since the 80s until today. Now, based on behavior science, what is your reading over the past many years? And I'm reading from a yearly chart. Sometimes a few seconds to analyze on this price behavior on the yearly chart. There's a lot of geopolitical behind the behavior. I just want to share with you my excitement about how I look at opportunity. Can you see that there's a lot of opportunity? Maybe I give you one clue. Next slide. I'm going to draw a straight line across. My question to you is that what can you conclude on its price behavior movement the past years based on this straight line? I think it's interesting. Now, what I reckon here is that OPEC, and it developed to OPEC Plus. OPEC Plus have never been so united before compared to the past. In the recent years, they are even more united. Now, what I could see that over the past years, they have tried to broke above 100 US dollars, but it failed. It tried numerous years to broke above 100 US dollars, but it failed. And after COVID, they try again, it failed. And now with OPEC Plus, so what is your reading? Now let's look at the next fundamental development here. Next one. So what I'm seeing that perhaps in this behavior, they are trying their best to break above 100 US dollars, but they failed for numerous times over the years. So could it be telling me that maybe in years to come, they are trying to break the upside? Perhaps. Yeah. Now let's look at some fundamental development. And we all knew that. Next slide. The first time that I read about this OPEC Plus that to cut oils of production is on April 2023. So we all knew that for commodity prices is that supply with lesser supply, the same demand, commodity prices should go up. So this is something that is very basic to understand. Now, where I believe that this is going to be a long haul, OPEC Plus, their decision. Now let's move on to the next slide on our analysis, where on our 10th of April 2023 sharing. Next slide. So this was what I shared. I read about the news on the 3rd of April. I saw this gap. This was the first time I read about OPEC Plus coming together to reduce the oil production in May 2023. And I saw this gap. So my projection is that I believe that you will try to break, retrace, and ultimately will break 100 US dollars and will move higher. Now, there's many reasons to look at oil prices and commodity prices. Geopolitical issue, OPEC Plus is another specifically for oil market. But what's the end result based on our April reading? Let's move on to the next slide. And what we're seeing is almost on track here. It retraced from about $65, it moved up, retraced, and now is nearing 90 US dollars. So I want you to relate not just oil, but the rest of the commodity prices, and how would that translate to the CPI? And then how would that translate that to the interest rate? Yeah, so this is something that worth to take a look at. So how I understand about inflation is I have one page, a few pages of CME commodity prices where I look at them. Now, so we saw in 2020-23, after bank run, the US stock market rally because of credit to the AI rush. So what's coming ahead? I believe that market has given us a lot of hints. So today we discuss about the lagging effect between the commodity, inflation, and interest rate. Let's move on to the next slide. We also understand about this 40 years interest rate. And what I took interest is that you have broke this downtrend line very convincingly. Just combine what we have discussed. Of course, today we have done time to discuss about all the geopolitical issue, but I just want to narrow down to the behavior signs of the price movement. And we could see that where is the inflation moving ahead based on the commodity price that is developing right now. Let's move on to the next one. And that was a Fed fund rate over the last 40 years. But if I'm going to look at the 2 years yield, 5 years yield, 10 years yield, 30 years yield, these are the cash market. And I got all the very similar reading over the last 1 year. You have broke above this 30 to 40 years downtrend line, whether it's at a Fed fund rate that we saw earlier, or the 2 years, 5, 10, 30 years yield. Now, all these are cash market. Can you participate in trading and hedging into the rising interest rate? Over the last 2 to 3 years, I cannot remember the specific launching of the CME micro yield futures. You can take a look at all these contracts, the micro 2 years yield futures, to participate and take advantage of this rising interest rate to come. Okay, next slide. So a lot of them ask me about investment and trading. They say, Kon Hao, what do you like to invest in and what do you like to trade? I told them that whatever that I find that's interesting, that's about to move, I would like to participate and trade them. So I don't limit myself to just one contract. I open up the net as wide as I could. So one of the first few platforms that I use whenever I see whatever market that's interesting, I'll look at the CME platform. And I like to use this platform here is that I include the QR code here. So I'll look at the study daily about the agriculture. So once you click into different ones, you're able to study into the contract specs and more details. But moving forward, as what we discussed, agriculture is something that I'm interested in. Energy, that's definitely something that I'm interested in. Equities, I find that there's an interest in it. We have studied about the AI hype. I'm waiting for the confidence to come in before I take action. So which I believe that is not too far from this point onwards. Next slide. So there's also Forex, interest rate, where we discuss about the all the different terms, tenure, the 10 years notes and the 30 years note futures. Metals definitely are very keen moving forward. And the micro yield that we spoke about, you can find that in the micro futures. Next one. Right, so if you're going to ask me that, is there a way to interpret these option prices or implied volatility in a very meaningful volatility estimates? And the good news is, last year, the third quarter, CME launched this CME Group Volatility Index. Now, it's not an index to be tradable, but rather it's a benchmark for you to look at the volatility of the market. For those that take interest, what is it for? Is to access, for the first time, access across asset class family of implied volatility indices based on a simple variance daily benchmark on CME data mine. Next slide. So all these are available for free, and you can study into the volatility market, each asset class and their volatility index. Next one, which is the last slide. So of course, if you have an interest in the CVOT, you can call the expert, or you can always go to their website to find out more. Last one, which is myself. Okay, so you can stay connected with me through my Facebook page. And CME Group did encourage me to produce a lot of videos. I know that today's presentation is 1 hour, but definitely they are very short snippets of 5 to 7 minutes sharing about what is happening to the market, to understand deeper, to do a deep dive about market psychology. So I took CME advice to produce some videos there. You can find them in my channel, Invest and Trade with Insight. My website, if you want to find out more what I'm doing, and definitely be welcome to receive your email on some inputs and some thoughts that you may have. Definitely for some data scientists, if you find that you can include what I shared to your formula, I think that will increase my productivity. So with that, I want to thank you, all of you, for your kind attention. I hope that this sharing, it is a blessing for yourself in how you can manage your fund for your company. And with that, I hope to see you again very, very soon. Thank you.